Many of you ask me how I invest my own money. So in this video, I'm going to look at my own portfolio in quite a bit of detail. But whatever you do, don't copy what I do, because my portfolio will not be appropriate for your risk appetite and your investment horizon. But if you do want more detail about this, there's no way I can cover everything in 15 minutes. There's a booklet that comes with this, which is free, and you'll find a link to that in the description of the video. So let's look at my portfolio in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start out by looking to see what's changed since the last time I updated my portfolio. Star Capital produces this valuation map of the world. The expensive regions are in red and the cheap regions are in blue. And the valuation measure we're looking at here is the cyclically adjusted price to earnings ratio developed by the Nobel laureate Robert Shiller. What the CAPE measure tells you is the number of dollars people are willing to pay for every dollar of earnings generated over the last decade. The earnings in the denominator are averaged over a decade because that roughly corresponds to one business cycle. And it also irons out the volatility of earnings, which tend to fluctuate up and down a great deal from year to year. This is how things looked in September 2017. This is May 2018, March 2019, and then finally September 2019. What's notable is that the US is still very expensive. It's still one of the most expensive regions in the world. The UK is still cheap, largely because of Brexit uncertainty, and Europe is also relatively expensive, whereas Russia remains very cheap due to concerns about sanctions against Russia, and Japan is also quite expensive. The reason why I look at cyclically adjusted price ratio is that looking a decade into the future, it's one of the best predictors of equity return. The number on the y-axis here is how much of the variance of stock prices is explained by each of these factors. You can see that Shiller ratio comes out top, but only for decade ahead returns, not for 1 year ahead, which is much less predictable. But even the price of stocks today divided by earnings over the previous year, which is here labeled PE1, is also quite predictive of returns over the coming decade. Unsurprisingly, rainfall isn't very predictive. So anything that's to the right of this is essentially noise. That's far from a very accurate forecast. There's still a huge amount of uncertainty about what equity prices will do, even though we do look at the CAPE measure. Currently we're at a CAPE multiple of just under 30, and you can see there's huge variability in the return of stocks over the following decade. But what you can see is that when valuations are very high, which is where we are now, returns tend to be lower than they are when valuations are low, at a multiple of around 10. And if we look up the average return over the next decade when valuations are this high, it's only a little bit above zero on average. Another factor I like to look at are the Purchasing Managers Indices, or PMI indices as they're called. When these are above 50, it signals expansion, and when they're below 50, it signals contraction. And in the Eurozone, the last time that I looked at my portfolio, these were falling very sharply, which was a cause for concern. Whereas in the US, the PMI indices were holding up quite well. They were still above 52. What's happened since then is that the European PMI has fallen further and is now just on the cusp of falling below 50. And even the US PMI, which until that point was very strong, has deteriorated significantly. And it's now 51.2 as of October 2019. So it's still in expansion territory, but it's certainly weakened. A weaker PMI index is a headwind for GDP growth. And a headwind for GDP growth is generally a headwind for corporate earnings and for equity prices. So overall, the picture for equity is looking a little bit worse than it was last time I updated my portfolio. A perpetual worry for investors is that China's going to slow down. But the Chinese PMI is actually okay. It's 51.9 as of September 2019, and the manufacturing PMI increased to 51.7 in October 2019. What's positive about that is that the orders placed with companies improved substantially in October, and that's despite the Sino-US trade war. But it's not all a rosy picture because business confidence has been weak. and the employment sector continued to contract. A big support for the Chinese economy has been these large infrastructure projects and, as usual, its very strong export market. So I'm not particularly concerned about China being a tail risk at the moment. If we look at the kind of infrastructures which are helping the Chinese economy, the rollout of 5G, which is happening this month, is a great positive. So far, it's only been rolled out in the largest cities, but large in China means really large. So Shanghai, for example, is 24 million people. That's almost 3 Londons. And even the smallest city in this list is almost as big as London. That's Hangzhou. And what's incredibly important is there's collaboration between business and government in rolling out this infrastructure. And according to the mobile telecoms organization GSMA, China will have about 40% of the total global 5G connections in 2025. One of the things that has changed a great deal is central bank policy, and in particular, Federal Reserve policy in the United States. At the October 30th meeting, the Federal Open Markets Committee, which decides US interest rates, lowered rates for the 3rd time in 2019. The reasons they gave for this was that this was insurance against ongoing risks, and they did it despite the fact that the economy in the US was growing at a moderate rate. There's certainly no sign of recession as yet. They've got strong household spending, which is very supportive of the US economy, which is dominated by services. There's a very healthy job market with extremely low unemployment at multi-decade lows, and US incomes on average are still rising, and there's solid consumer confidence. On the downside though, business investment and exports remain weak. There are clear signs that manufacturing output has declined over the past year, and sluggish growth abroad is starting to affect the US. And of course, there's the trade war, which is now starting to weigh on the US economy. The European Central Bank has also responded to the weakening of economic data, and its response has been to make its negative interest rates even more negative. The European Central Bank gives 5 ways in which it's implementing its very accommodative policy. Their most important mandate is to keep inflation at or just below 2%, and it's been consistently undershooting that level for some time. They also announced that they're going to restart net purchases, in other words, quantitative easing, which they call their Asset Purchase Program, or APP. They'll keep on reinvesting the principal payments from any bonds which mature, and they're restarting their TLTRO program, where they reward banks which lend to the real economy by giving them favourable interest rates. The Bank of England, on the other hand, has not cut its interest rate. Its official bank rate is still 0.75%. Although if financial conditions start to deteriorate after Brexit, they may have to cut interest rates in order to stimulate the economy. But they have said that cutting interest rates after Brexit is not a foregone conclusion. Now let's look at the market changes. My portfolio now has quite a bit of exposure to the United States, but also to Europe and to a lesser extent Asia Pacific. So if sterling strengthens, that's bad for my portfolio. Here's the value of sterling versus the US dollar. And after they announced the general election in December 2019, sterling rallied considerably because the probability of a no-deal Brexit fell sharply. And in turn, that's hurt the non-sterling parts of my portfolio. This is what the risk-return plot looked like for Vanguard funds between 2016 and April 2019. Risk is along the bottom, so high risk is on the right and low risk is on the left. And return is on the y-axis. So low returns are down here and high returns are up here. The 3 funds I chose in April were the Global Minimum Volatility Factor, which is one of Vanguard's global equity funds, but also UK investment grade corporate bonds because I didn't want to have too much equity risk in my portfolio. And I also bought some emerging market government bonds because of their very high dividend yield. If we update that graph for October 2019, the story is pretty much the same. Global minimum volatility is still performing fairly well compared to other assets. My safety play, which is UK investment grade corporate bonds, have done their job, which is to have low volatility and to provide a little bit of income. And emerging market government bonds have held their value and they provided a very high level of income. And if we rank those funds available from Vanguard by their 12-month yield, you can see that at the top of the table, we still have Vanguard US dollar denominated emerging market government bonds with a yield of over 5%. Now, the way I've chosen to beat the market is to have factor funds. The factor I've chosen is to have low volatility. And in a previous iteration of my portfolio, I had a global value factor fund. But if you want to see more detail about that, there's a whole video about it. Vanguard offers 4 of these factor funds: global value, which buys stocks which are cheap according to 3 valuation measures, a momentum factor fund, which buys stocks which are trending upwards in price, a liquidity factor fund, which buys stocks which have low liquidity, for example a big bid-offer spread and small daily traded volume, and finally the fund which I went for, which was a global minimum volatility fund, which chooses stocks for optimal diversification and low risk. Another reason that I like the Global Minimum Volatility Fund is that it contains a lot of real estate investment trusts, and these offer quite good income over the long term. One of the reasons I don't like this fund is that it has a 50% exposure to the US, and as we saw, the valuations there are very high at the moment. So let's finish by looking at the portfolio changes. From watching previous videos and looking at the booklet which describes how I allocate, you'll know that I start from risk. And part of that is my Scooby-Doo tree. And in this tree I characterize various markets using characters from Scooby-Doo. And that's because a tree is a very simple way to visualize the behavior of asset classes, just as you could describe the characters in Scooby-Doo using such a tree. What's different about this tree is that it's sideways. It grows from left to right. And this is what the correlation tree looks like using the latest data. It splits very cleanly into bonds at the top and shares at the bottom. Bonds I've characterized with Velma because they're kind of boring, and shares I've characterized as Scooby-Doo because Scooby is a little bit exciting and a little bit crazy. And notice how I've chosen one fund from each part of the tree. That way I'm not doubling up my risk. So I've chosen emerging market government bonds at the top of the tree. I've chosen UK investment grade bonds in the middle of the tree. And from the equities, which are all shown in blue, I've chosen the global minimum volatility factor because I don't want to take too much equity risk. Now it turns out that my new allocation is the same as my old allocation. So the only question is, should I rebalance my portfolio? There are various optimal ways of choosing a portfolio, but for these 3 funds previously, I chose a slightly modified version of a risk parity portfolio, where the contribution to risk of my portfolio is the same from every asset class. In practice, that means you have very little equity in your portfolio because it tends to have a higher risk. I then took those risk parity weights and adjusted it so that I had 60% bonds in my portfolio and 40% equity. And when I do that, I ended up with 20% of the emerging market bonds, 40% of my portfolio was in UK investment grade bonds, and the remaining 40% of my portfolio is in equity in this minimum volatility fund. If I rebuild these optimal portfolios using the latest data, the numbers come out exactly the same. So for now, I'm not going to change my portfolio allocation. There's really no need because my portfolio weights are pretty much where I want them. So that's 60% bonds and 40% equity. If the markets had moved a lot, then I would have to rebalance, and I might do that in a future video. But for now, there's no need to do anything. So to summarize the changes, the macroeconomic data's got slightly worse, but the central banks, particularly in the US and in Europe, have become more accommodative, and that should counteract those negative effects on the economy somewhat. But I'm keeping a very close eye on those things which we looked at, which is non-farm payrolls, the spread in credit markets, volatility in markets, but also the PMI indices, which give you a forward-looking idea of what's going to happen to growth in the near future. So I hope you found that video useful. If you did, remember there's the booklet, which you'll find in the description, and you can always contact me for a power hour. You can either join us at the Patreon $25 a month level, or you can pay a one-off fee for that. And I'd be more than happy to discuss any of this or anything else you're interested in more detail. So as always, thank you for listening.